These 5 small-cap dividend stocks are best of breed. They've been increasing dividends for 53 years in a row on average. Did you catch that? I said increasing, not just paying dividends, but increasing them for over 50 years. By how much? An average of 10% per year over the past decade. By the end of this video, you'll not only know 5 likely new quality dividend small-cap stocks, but you'll also know how we selected them. But first, a short story. It was a foggy London afternoon and I looked around the office. Lots of boring-looking people with even more boring titles. At best, they were helping the rich get richer. At worst, they were developing a heart condition and a bad case of office ass. I need to escape this grind. I need to do what I love. I need a passive income source, I thought to myself. That's when I started developing Quantigence. Now, the problem I was solving for was this. Dividend growth investing stocks are what Buffett calls equity bonds. Your income increases every year while your initial capital remains untouched. So these are quality names by definition, but I thought we could do a whole lot better. How do we find the best dividend growth stocks? Now, the method needs to be objective and transparent so everybody understands it and can replicate it. It should focus on the ability for a company to keep increasing their dividend. And I looked for a scoring factor-based mechanism based on accurate data. And these are the factors that I came up with. So, size. This improves the odds of survivability and helps a company enjoy competitive advantage. Years increasing, the longer the track record, the more durable the income stream. International sales, because it's not just about the USA anymore. Yield, but this isn't as important as growth. So 5-year and 10-year dividend growth rates. That's how fast your quality of life is improving relative to inflation. And of course, payout ratio, that dictates the sustainability of that growing stream. It's pretty important, and that helps to reduce turnover because the only reason we ever sell a dividend growth stock is if they stop increasing their dividend. So when we developed this strategy, we rewarded size. So if size is given a premium, then small cap stocks by definition are less desirable. So our universe, our core universe, utilizes a market cap cutoff similar to index providers. Now, while small caps are said to enjoy a premium over time, they're often pursued by investors for the wrong reasons. So a small cap company is not cheaper because of its size. The same holds true for a share price. Nor does the small size of a company mean there's loads of upside. And we're going to discuss that later. Companies typically stay small for a reason. So without further ado, we spent thousands of dollars licensing data from NASDAQ to produce the most comprehensive list of dividend champions out there. This is available to all our premium subscribers. Now, our core universe of 80 champions you already know. What we're adding to that is a universe of 43 small cap dividend champions with an average size of about $3.9 billion, average yield of around 2.8%, etc. Now, you want to see the list, don't you? Wyatt?
If you're a premium subscriber, just reply to any email we send and ask us for the small cap champion spreadsheet. We'll get that right over to you. By next month, we're expecting to have our Q-Score calculator live so you can browse through 120 U.S. dividend champions along with international champions and contenders, which have raised their dividend for less than 25 but more than 20 years.
Thanks, Wyatt. So finally, what you've been waiting for, the 5 small cap dividend champions that scored highest out of the 43 that we ranked. So you see here, this universe of 43 broken down by sector. This is kind of interesting. So what's dominating there would be financials, utilities, followed by industrials. But look at our top 5 list there. We have 2 materials stocks, the only 2 materials stocks in the small cap universe. We have the only real estate stock, and then 1 consumer staples and 1 utility. So I thought that was rather interesting. So let's look at what drove the high Q scores here. So you see the table on the bottom there to the far right, those numbers in green. That's the total Q score, and then the numbers to the left of that are what add up to form that Q score. So I wanted to point to a couple things here. First of all, notice the QM cap column. So that simply rewards on size. As you can see, these companies aren't being rewarded because they're small. Only 2 receive minor rewards because I think they're above $3 billion market cap. That's the reason they get a small bit of reward there. Then look at international sales. What's interesting about this is for REITs and for utility companies, because the majority of those operate within the United States, we don't calculate an international sales score. We zero it out instead of penalizing. That's what we do to companies in other sectors that operate in in the United States solely. I think the penalty starts at where 80% or more of revenues are coming from the United States. So here you can see these 5 names, and what we're going to do next is this. We're going to try to figure out what each company does, what exposures we're getting for holding each one, and we're going to identify a next step for due diligence. So this is the first time that I've looked at any of these companies, and I just want to make some comments. Let's start with Universal Corporation. So we see here they refer to themselves as being an agri-products supplier, and you see they say leaf tobacco and plant-based ingredients. So I haven't been able to figure out the synergies there, but you see this statement, the leading global leaf tobacco supplier. So we like investing in leaders, and you see they talk about strong barriers to entry. Presumably this would be relationships in the industry and perhaps with growers. They point to their tremendous dividend track record of over 50 years increasing dividends. Looks like they have some international operations in more than 30 countries. Now, this slide is rather interesting. It talks about how 2/3 of their sales are to customers with major positions in their respective markets. They talk about their largest customers being Altria, British American Tobacco, China Tobacco, Imperial Brands, etc. In total, these big name tobacco companies account for more than 60% of their consolidated revenues over the past 3 years. 5.5 trillion cigarettes a year are produced by the global tobacco industry, yet only less than 5% are consumed in the United States. That's rather remarkable. I had no idea. And they state here something that is of interest. They believe that growth in world consumption of cigarettes peaked several years ago and is declining. So that's not good if you're producing the raw product for cigarettes. So what they're planning to do is pivot into ingredients. And whilst this only accounts for 14% of their business, you can see these acquisitions they're making. This is their plan to pivot. And I think a next step here for investors interested in this company would be to better understand this pivot. What gives them a competitive advantage over other large ingredients companies? So moving on to the next name in our list, we have Universal Health Realty. And I think this list of healthcare REITs is fairly comprehensive. This is from Hoya Capital. And when it comes to REITs, we just don't like second place or laggards. We only invest in leaders, and that's because external events and risks can drastically affect a REIT that doesn't have very many properties. You see here that UHT has 76 investments in 21 states. Medical office buildings and clinics make up 70% of their investment. Now, looking at their numbers along the bottom there, notice that high yield. That's a concern. It's possibly a yield trap. And how are they able to grow this dividend that quickly over the past decade? You can see they've been growing their dividend at a compound annual growth rate of 19% over the past 10 years. Now, this is attractive, right? Strong dividend growth rate and high yield, but there's no free lunch, right? So I think the next step would be to look at the reasons for that. Now, the third company in our list, Stepan, they operate in 2 primary segments, surfactants and polymers. Their investor relations deck could use a real tune-up. It's pretty shoddy, but I liked these charts here. So for their 2 major segments, you see they do these step charts that show revenues, sales from one year to the next, or this is from one quarter to the next, year over year, and they show the changes in volume, price mix, and foreign currencies. And then for adjusted EBITDA, in other words, their profitability, they're showing geographies, North America plus Asia, Latin America, and Europe. So rather interesting. When we look at the broader picture here, you can see those 3 segments, the 2 primary and that 1 minor, surfactants, polymers, and specialty products. The commentary here just begs for further investigation. They talk about operational issues at the Millsdale site affecting both of their largest segments. And I think that was some flooding, so out of their control, but it merits a further dig. And so does this comment about corporate expenses up due to the Asia fraud event. Well, that's definitely worth looking at what happened there. I'm not sure, but that's a next step for investors who would be interested in this company. Up next, we have H.B. Fuller. So they point to this global business unit update in their earnings deck. And what we're led to believe here is they're a leading adhesives company operating in 3 primary areas: engineering, health, hygiene, and consumable adhesives, and construction adhesives. You can see here they're quite focused on profitability for these three segments. That's great. So they're a relatively mature company, so it's understandable why they'd be looking at those metrics. For 130 years, they've been a leading global adhesives provider, and this breakdown here shows you the revenue by segment and also the profitability. So you can see that construction adhesives appear to be less profitable than the other two segments. And this firm has a low payout ratio. Over half of their revenues are international, and they have mid-single-digit dividend growth, but a very low yield. So I guess the next step here would be to better understand the adhesives market. AI tells us that they're the second largest player and that adhesives are worth $50 billion, Henkel being the largest. So their plan to expand would obviously be through acquisitions. Curious about their expansion here into fastener and locking solutions and what sort of companies they'd have to compete with as they move into a new space. So I wanted to make one mention of something called a small cap premium. And there's a theory called the small firm effect theory, and it is that smaller firms with lower market caps tend to outperform larger companies. So numerous studies have pointed to small caps outperforming over long periods of time. Now, the argument is that smaller firms typically are more nimble and able to grow much faster than larger firms, but they also happen to be more volatile and risky for investors than large caps. Now, just be careful about confusing the small firm effect with the neglected firm effect, which is that smaller companies don't get a lot of attention from analysts, so they enjoy less rich valuation. So questions here. A dividend king, by definition, has been around for 50 years. If a small company is supposed to grow faster, why aren't these companies growing faster? So the fact that you've only grown to be a $3 or $4 billion company after 50 years means you're probably not growing very fast. The other question is this: birds of a feather move together. So does the stability of a dividend track record, such as this 50-year track record you see for 4 out of 5 of these companies, does that provide a quality signal that reduces small cap risk? I don't know, but there's certainly some interesting conclusions to be reached about small cap dividend stocks. And our Q-score method allows you to select companies quickly and objectively, but you can choose to apply subjectivity if you like. Now, all these companies discussed today, I think, could use an investor relations refresh. I was surprised to see 4 out of the 5 of them are dividend kings. That means they've been increasing their dividends since at least 1973. Now, after going through this exercise, I think it reinforces in my own mind why we focus on larger companies for our own portfolios. Small cap exposure may appeal to others for understandable reasons, but for us, I think we're sticking with our core universe. Now, astute subscribers will have noticed that I haven't talked about the 5th company, American State Water. That's because we took a look at this company in a recent video, and you ought to give that a look next. Thank you so much for taking the time to watch this today.